One of the biggest risks facing retirees isn't always the market going down. It's when the market goes down. Two investors can have the exact same average return over time and still end up in dramatically different places depending upon the order in which their returns happens. This concept is known as sequence of return risk, and it can have a huge impact on retirement income and long-term financial security. Today, Ben and I are going to break this down, what sequence of return risk is and why it matters so much when you're looking at being able to make sure your money can be able to last and what investors can do to protect themselves. So stay tuned. You're not going to want to miss this.
Welcome into Legacy Beyond Wealth. Glad to have you, Ben George, with Rob Shelton. He is the founder of Axio Wealth Management. Today, if you're approaching retirement, getting close, this is an important one to be paying attention to and be thinking about. And if you haven't heard about this returns risk, the sequence of returns risk, this is going to really, I think, inform you and be better prepared for retirement. At least better ask better questions with your advisor or your wealth manager. Make sure you're having these discussions and planning appropriately, because I think a lot of people are thinking about just their portfolio performance year in, year out. But as you approach retirement, again, it just changes the way you view things. You need to make sure you're on top of that. So today, what we're going to do is we're going to walk through 5 key ideas to really help you understand as an investor, how to better manage these sequence of returns risk. So Rob, let's just jump into it. And I want to start with this. The risk is about timing. It's not just about returns, right? So explain how you have to rethink this a little bit.
Yeah, a lot of times, and the best way I had this explained to me, and being in Utah, this made a lot of sense. If you design a house or a building to withstand the average snowfall in a year, what happens when you have a year that has more than an average snowfall? And, you plan on that roof being able to continue to support that same weight. And so that's what the sequence of returns really is. It's getting away from just using an average number, because if you have a really bad snowfall or a really bad downturn in your portfolio in the first few years of retirement, it can have a dramatic impact upon how long that money could be able to last for you. And you actually run into a risk of running out of money early before you pass away if you have those negative years in the first few years of retirement. And you contrast that with someone that maybe retires and it has a great couple of years, the first year in retirement, they can be able to maybe withstand some of those downturns a little bit better. And so it's really important to understand that concept.
Yes, remember, it's about timing, not just returns. And as you pointed out, those early retirement years are the most vulnerable, right? Those are the ones you really have to be paying close attention to with the way that you're withdrawing money and the way that you're planning.
Yeah, and it has to be done strategically, and that's something we've done with all of our clients. Whether it's they're magically retiring and hanging it up for 40 years, or they've sold their business and they're saying, okay, now I want to be able to live on this income the rest of our lives. We talk about that critical 4 years leading up to and the 4 years after retirement really being so critical to make sure that we have the right strategy in place, that if a market downturn happened, you're insulated from that having a huge impact on your income and future ability to be able to live that life that you want to.
Yeah, this is one of those where if you're not planning ahead of time, right, you're going to miss your window. It could be too late to make adjustments if you fall in this time period and aren't properly prepared and very strategic about your approach. So make sure you pay attention to that in the early years of retirement. Diversification and asset allocation matter. This is our third point here. And again, you might say, well, doesn't it always matter, Rob? Diversification, I hear that word all the time. But what's so important about it here in this conversation?
Yeah, I think the biggest thing we want to do is, I'll give you an example. I had a client that came in and met with us during after the 2008, 2009 financial crisis, kind of the meltdown, the big one that most people that lived through that remember. And his portfolio took a substantial hit. And he and his wife in a really difficult position. But through working with them, we were able to get them back into a better position. But having a well-diversified portfolio isn't just having different stocks in your portfolio. There's a reason and a time to be able to have cash in your portfolio as well. It's kind of like carrying an umbrella in your car. You hope you never need it, but boy, you're sure glad when it starts to rain or the storm comes that you have it. And so, taking a look at that and having that structured in a way that makes sense is very important. Now, that being said, I could go to the other extreme and meet with some people that are completely sitting in cash and they're too scared to be able to invest, and that inflation is going to eat them up in the longer run. And so that diversifying doesn't necessarily eliminate risk, but it's about how do we balance the risks out and try to reduce the impact of all of our eggs necessarily being in one basket.
All right, again, if you need help doing that, again, AxioWM.com. Start there in that discovery call. Best place to really begin preparing and making sure you're planning for your future. All right, our fourth point here is having a withdrawal strategy is so critical. Again, kind of putting all these pieces together. But how do you help someone have the right withdrawal strategy?
Yeah, I mentioned just earlier about having cash in a portfolio, and that's where we would love to be able to see 1 to 3 years worth of cash sitting in what we'd call our first bucket strategy. That is supposed to be able to be the insulator that the markets turn down. You can take money out without the worry or concern that you're liquidating investments that may be at a loss. It buys you time to allow the market to be able to come back, or for whatever the economic issue or worry was that caused the downturn in the markets to be able to be worked through. And being able to buy that time with that first bucket, kind of the insulator or buffer that's there, has a huge chance of increasing someone's ability to not make a critical mistake when those downturns come, and allows for that short-term planning needs that are held in far safer assets.
Are you ready to unlock the freedom to live your best life? Schedule your no-cost 60-minute discovery meeting with our team today. During this session, we'll take the time to understand your family's story and financial dreams. Together, we'll craft a personalized roadmap designed to help you achieve your goals. Let's explore how we can unlock the freedom for you and your family to thrive. Just click the link in the description of today's show to get started.
All right, our last key idea here to remember is that planning ahead reduces the emotional decisions. And, that's oftentimes where people get off track, right? It's not just in retirement. It's as they're investing throughout their lives. When the market goes down, right, that's when you react a lot. So how much does planning help here, Rob? We stressed out a lot, but how do you help avoid these emotional decisions through planning?
Yeah, this question came up recently. We had a bunch of university students from the local university into our office. And I always love to be able to look at how we can mentor them. And so every 90 days, we bring in students and just see what questions they have. And with the recent volatility, the war in Iran and what's going on and the price of oil, that's all over the headlines right now. And this one student had a lot of fear and concern about having the trust of someone's money that he would be entrusted one day to be able to invest. And he wanted to know, how do we handle that? And I think the thing I gave him was the most important thing to do is you don't talk about how to handle down markets when you're in the middle of a down market. You got to talk about that during the good years. And for the last 3 years, every 90 days with our clients, we're going over and saying, hey, what happens if? And so, I'm grateful that we even reviewed that over the last 2 months with our clients. So we find that emotion is in check because something we've already planned for, we've talked about, we anticipate it being able to come, and we know it's just an ordinary course of events that takes place in the current market cycle, and it doesn't cause the anxiety to go up. So make sure that you have that plan in place ahead of time, and those discussions in the good years are just as critical, if not more, than when the rainstorm has already started or those market downturns are already coming.
Yeah, absolutely. And the sequence of returns risk, it's one of the most important, but it is often misunderstood or just not as understood as other aspects of planning, right? These concepts we go through, this one gets overlooked quite a bit. But what we're talking about here, Rob, is that it's not just, hey, you might not have as much money. It could truly jeopardize all that you've worked for, right?
It can. In fact, I remember talking with a gentleman who retired in the airline industry, and he talks about being back during 9/11 as a young worker and seeing how the whole airline industry was impacted and how people, because they didn't plan appropriately, had to come back to work or extend their retirement date of when they're able to retire. And if you're wanting to be able to plan, you want to try to keep those events as far away as you possibly can. So taking this risk into consideration and having a discussion with your advisor will pay huge dividends in the long run.
Yeah, thoughtful planning, diversification, and the right strategy can really help you significantly reduce the impact of market volatility during retirement. So start that planning now. Log on, AxioWM.com, learn more about Axio Wealth Management there, and also take advantage of that discovery call. Begin working through the process and your goals and your questions and concerns with Rob and the team there. But we appreciate you watching another edition of Legacy Beyond Wealth. For Rob Shelton, I'm Ben George. Take care.
Thanks, Ben.